So good evening, friends. It's pleasure connecting you all in another insightful session organized by PMS Bazaar. Thanks for taking your time and joining in with us. So October 2020 is a very special month for portfolio management services industry and also for the investor community. So there has been always a perception that PMS is not as regulated as mutual funds. Now there has been a lot of changes which has been taken from SEBI, made by SEBI in the interest of the investors. Now client will enjoy no entry load, exit load has been capped, and there is a direct option which has been introduced similar to mutual funds. So there are plethora of changes which has made in the industry in the interest of the investor, which is a great news. But the best part of this new regulation is that the freedom of the portfolio manager is not being disturbed, and hence the portfolio manager will enjoy the benefit of having a freedom in managing the portfolio. So according to us, the regulation when comparing with mutual funds, it is definitely akin to mutual funds. However, mutual funds cannot be akin to PMS looking at the structure of the product. So with that great news, let us move on to our today's session. Today we have Mr. Rohan Mehta with us, who is the CEO and the fund manager for Total Wealth Management. The topic for today's session is that the driven fund and the importance of the risk management system. Let me give a small introduction about Rohan Mehta before I hand over to him. Rohan Mehta is the CEO and the fund manager of Turtle Wealth Management. He is the author of best-selling book 212 Degree, The Complete Trader. That is a unique comprehension to what an extra degree can potentially achieve in life. Hailing from business family and renowned in Gujarat, Rohan is a professionally qualified master in business administration with a rich experience of working in institutions like Standard Chartered Mutual Funds, Jhaveri Securities, Anand, Rathi, and Jainam Shares Consultants. With more than 15 years of experience that includes working on quant strategies, economic research, etc., Rohan focuses on investing in various themes in equity markets with his unique investing style of understanding the price, skin of business, risk, and the growth of the company. So welcome, Rohan, and over to you.
Thank you, Rajan. Thank you, the whole PMS Bazaar team. I still remember when I first met Daniel and understood your vision, and I was like that. You are doing great in something which nobody else did. So I'm so proud to be associated with you guys, and I just feel that it is just a company which has the same energy which we have. So thank you for giving an opportunity to be on your platform and looking forward for a lot of things in future. So welcome all the guys who just joined the webinar, and I in the next 35-40 minutes I'll try to make something which is more gyan or more vigyan rather than gyan. So I would like putting up the stuff like it would be more science which you can execute, and rather less of a mumbo jumbo, which generally it looks good to listen but very hard to execute. Because I come from a very simple family where my forefathers has never been into stock markets, not from my mom's side, not from my dad's side. I had been into the love of markets because I lost 50,000 from my dad, which I took as investing in Reliance Petroleum Limited in way 2005-6, which eventually I made it. I all the 50,000 I lost because of trading and investing, and then I thought that to recover that 50,000, the whole 15-20 years I dedicated. Of course, now that 50,000 is not the cup of tea, but that 50,000 leaded me to do hard work, to do more research, and to come down to a point where I create my apron. So in markets there are two type of things which happens. One is wearing a bib. So bib is when छोटे बच्चे को पहनाते हैं when जब खिलाते हो, somebody feeds you, and second is wearing an apron. So very way back in my life I understood that I need to wear my own apron. Maybe read more than 1800 books, books, met the best of the best investors, including Warren Buffett, Munger, and I created something which was comfortable to me, to my clients, and the way I come from. I come from a very basic middle class family. Understanding the value of the money is so important. I can't tell to myself that okay, fine, 10 years is fine with me. 10 years, if return doesn't come, it doesn't make difference to me. And I'm sure all of whom you are listening, every year, every quarter makes a difference to you, and that's how I have been approached. I've been told that money doesn't grow on trees. Every penny counts, and yeah, of course, I come from that background that money is so important. So every why I'm telling you all this is not because just to put my background in, because it is so important to know your fund manager's background, because if he comes from that specific background, the values also are onto that level. So I'll take very fast to what we do, what are onto that stuffs that will make that has we have imbibed a process driven approach where 95% is vigyan and 5% is gyan, where 95% is process driven approach, where we tell our clients, our teams, that this is how we are going to articulate our approach, and not going to take any unnecessary unhuman calls or emotional calls out of the markets, because markets every day something new happens. But if you have a system driven approach, most of the times you will be in your profitability. Last 15 years of my professional investing career, maybe market has been so kind to us. I've seen six seller circuits, people losing millions and billions. I've seen more people to lose money rather than to make money. And I've on the whole approach, I've seen one thing is that what you can do to not lose money in markets, and that's what is all about. I'm going to tell on this one. We are, as you all know, we are Turtle Well. We are SEBI registered PMS fund managers. We manage more than now 200 crores of assets, and investing. Our first fund is Wealth Mantra, which focuses on investing into growth and leaders. But before that, whenever you see a fund or a process, most of the people in India, there is an irony which I say to everyone is that when I talk with an NRI client or an institution, the first thing they ask is what is the risk for the fund. And when I talk to an Indian resident, the first thing they ask is what is the return of the fund. And I the same human talking different things, because somewhere across we are so much influenced by the returns and so much less influenced by the risk. In my last 15 years of experience and reading 200 years of the history of finance, the one thing we have understood at Turtle is that it is the only risk that you can manage. The returns are something which is on markets, because risk is in your control, returns are not. So the most important thing when you make an investment decision is the purpose, then the process, then the performance, and of course last the price what you give for the fund. So I'll take one to cross. I'll not bore you for sure, and make something which is more exciting. So, our investment objective has been that endeavor to create 100x of wealth in next 25 years with a CAGR of 20% by investing in outstanding businesses where leadership and growth are in common with a bottom-up approach. हम 100 times wealth बनाना चाहते हैं for our investor with a 25% of 25 years of a horizon with 20% of CAGR. That's our target. By investing in businesses which are having externally moat and leadership and growth together, and we don't see markets generally what is nifty sensex or maybe a specific index, but our approach is simple. अगर धंधा अच्छा है तो हमारे में वो धंधा हम पैसा डालेंगे. If the business is good, we will invest into that business. As simple as the process, because the more complicated you make, it looks good to talk, but it's very hard to execute. So at Turtle, we have an Apple philosophy. Make it so simple that a kid also can understand the process, and that's how we do it. So just to give a brief about our team, of course, I'm talking. Vivati handles the whole back office. She's the CEO of the company. Does the whole back office and account auditing. Hardik takes care for the whole business. Ayushi and Sachi are CFS, and they are also the research analyst for the main fund. And of course, there are a lot of people who are again into the backing of the team. So I'll talk what are the sutras we have understood from 15 years and which we really understood so well. Like you can say, a Gayatri mantra or a azan or a naukar, what we religiously follow in our home and our life. This is sutras what we follow in our investment decisions. So first is unlimited upside and limited downside. So any business we do, any investments we do, we are going to see only unlimited upside, and where the downside is very limited. In investment we forget a very important thing, that is called risk adjusted returns. Like for example, I'm investing in a company where the risk can be 100% but return can be 300 400% or 3x, or a company where the risk is 20% and the return can be maybe 20% CAGR. Most of the people understand that 3 or 4x a company return could be good, but actually it is the other way around, which is more less on a risk and consistent on a return, which gives you a better return over the period of time. Because if you lose 100%, and again it takes so much amount to get back to what you have lost. So Rome was not built in a day, but can be destroyed in a day. Wealth, the same way the wealth cannot be made in a day, but it has the power to destroy in a day. We saw COVID, we saw the stocks which destroyed in a month nearly about it 50-60% of the value. We have seen so much of the things in 2008, or so many examples where a company can be destroyed, can be a Yes Banks of the world or a Vodafone of the world, and we have seen, the Idea Vodafone of the world, Tata Motors of the world. These are great names, but can be destroyed in a day. Day means over the period of time. We don't have to be smarter than others, but more disciplined than others. So we don't want to be smarter than others. We don't want to say that, okay, fine, I know where the market is going to go. No, no, no. But let us focus more on the process and align to that process. Quality of the investor weighs higher than the investment idea. This we always see it, but we experienced this in COVID times where we never had any redemptions, and none of our client eventually called up on the pressurized phone, because the way we deal of our investment, we believe one thing is that at night a fund manager and client both should sleep peacefully despite of anything which can happen to your investment, or whatever happens to an SGX Nifty or Nasdaq or Dow Jones in international markets. Our patience will be tested, but our conviction will be rewarded. So there is a lot of times I've seen that your patience is tested. But if you are convinced in what you are doing, you will be rewarded over the period of time. I'll give you an example of a company what we are holding from last. Of course, the PMS license we have got is a year old, but we are holding this company on a personal side and advisory side from last 5 years, and this company has been consistent. There are times years where the returns were not that great, but over the period of time, it has been one of the best return. Our favorite holding period is till trend ends. So there are so many funds, or a fund manager or an investor who will tell that my favorite period is 10 years, 5 years, 3 years, 2 years, 15 years, 20 years. Honestly, these are all things which has no exact metrics that it is right how many years you should hold. So a Buffett can hold a IBM for 5 years, or an airline industry for 5-6 years, and a Coca-Cola for now centuries. So how to dedicate that, how much time you have to invest? Our simple philosophy is that till the positive trend ends. So there would be cyclical investment, there would be stocks which would be doing good for 3 years or 4 years, half a decade, and it would not be doing good for a longer period of time. Honestly, in hindsight, we understand that this is the right way if you would have hold it for 20 years. But there are so many examples that if you would have not exited in the right time, you would have eventually lost all the money, the wealth created in the stock. So our best holding period is till the trend ends. We don't invest for 1 year, 2 year, 3 year, 5 year, 10 years. Till the trend ends, we will hold that strong, and it is a long-term positive trend. More makes more. You should know. We believe that investing in very exciting business or very volatile business doesn't make a long-term great wealth. But of course, boring things makes more money. People have said that a lot of IT industry eventually in 2000 which made more money, but I'll tell you that FMCG has made more money in the whole world rather than any other peripherals for a longer period of time with the least risk. That's how the wealth has been created. Profit takes care of itself, but losses never do. You need to focus on the lost stocks which are not doing good and replace with the stocks which are consistently doing good. That's a very clear mantra. So we focus in 15 stocks. It's like a cricket team for us. The stocks which are the players which are doing good, let they do good. But the players which are not doing good, either you see how they are reviving, or you replace it with a good player. That's how it is going to be. And secret sauce, I think so there are two qualities which any fund manager should prevail is. First is that pyramiding the on profits. You're buying something at 100 rupees. If the company is doing more better, you have the execution power and an audacity to again buy at 200 or maybe 300 or 500. I'm just telling you numbers, not the percentage, but just you should also have the audacity to buy on the higher numbers, and the acumen to exit also in losses. That if something goes wrong, you should be open-hearted, that okay, fine, we went wrong, I will exit from the stock. I'll give you certain examples where I think so. We were so convinced about the story about the company, but nothing happened, and we exited and shifted to a different company which has done overall more better than what would we have holded that company. So that's our sutras. This is very interesting. I took this because of the sake of the knowledge, and is the power of compounding is it takes 4 years at 20% of return. It takes 4 years to 1x your wealth, means double your wealth. 13 years to 10x of your wealth, and 26 years only to 100x of your wealth. Now, when you do first double your return, it takes 4 years. But when it does 10 years, 10 of your returns, 10 times your return, it only takes 13 years. But when it does 100 of your return, 100 times of your return, it takes only 26 years. But the real game over here is that why people don't make money in equity if it is so simple. The only reason is that 95% of the people will exit here, 90% rather. From that 90, again left 10, 90% will exit in this time. And from next least left people would eventually make a lot of money, and then we will tell a lot of examples or maybe stories about that. So this story come from my mentor, who told me, ask this question, that if there is a pond, every day there is a pond which comes out with a new flower. So for example, the first day the flower is one, second day the flower goes two, third day the flower goes four, fourth day the flower goes eight. So every day the flower doubles out. On the 30th day, if the pond gets full, which is the day the pond will be half? Anybody who can answer, who wants to answer? Which will be the day, कौन सा दिन होगा जब वो तालाब आधा होगा? Anybody who doesn't know me and who wants to answer? Yeah, so Vivek is right. So Vivek, it's 29. So yeah, most of people know this story. But the point is that till 29th day, you are only at the 50% of the return. 29th day, that is your 98% of the time, you are only at 50% of the return, and then it doubles down. That's the power of compounding. This works in health, in your gym, in your running, in your money investing, in your business. Everywhere it is like that. So it's not only in investing, but everywhere. Most of the people, when I play squash, most of the people tell me that I'll play for 3 hours and improve the skill. It doesn't work like that, because your body will get destroyed. But that's how it works in investing also. So this is a very great data which was been posted by Putnam Investment, that if you have invested value in 2018 $10,000, in 2004 till 2018 in S&P 500 index US, what would be the return? The fully invested would be from 10,000, it would be $30,000. I think so. That's a decent return. But if you have missed the first best 10 days, it would have gone to 15,000. And if you missed the best 20 days, which is eventually from 14 years, only 20 days if you have missed, you would be again at the break evens of your investment. So that 20 days eventually makes the whole return. And most of the time, we have to be in that game. You don't know, as it comes on that note that, you have to be on the pitch. There will be time that ball will come on bat. So only liars manage to always be out during bad times, and good during good times. So this is how. And if you miss the best 40 days, you eventually lose 50% of your investment amount. So that's how it works. This is so important to understand. So now come to the point is the cycle of the markets. So there was Harshad Mehta, then it came Ketan Pare, then it came Lehman Brothers. Then we invested in investment in quality stocks, and then there is crisis and opportunity, which is the current opportunity. So in the crisis and opportunity, the stocks were different, but market did on the south side of the north side of the market. The same thing right now is a totally different change. It may take time, but we feel at Turtle that it is one of the most wonderful opportunity which one can have. So a lot of people ask that is this the right time to invest? So we have again, being a cricket buff, I've taken an example of Kapil Dev, Saurav Ganguly, Sachin Tendulkar, Sehwag, and Rohit Sharma. So when Kapil Dev made in 1983 173 runs, people thought that this is the best. Nobody can make more than this run. And eventually, when we saw in 2014, Rohit Sharma made 264 runs in one ODI, and that too into that scale which before it was the total team run, that was individually his run. And what is more interesting over here is that the score went up, but the players were different. So this time also, maybe next 5 years or 10 years, when you are talking, the stocks which were previously the multi-bagger, we believe that there will be the change of the multi-baggers in coming time. There will be different companies, there will be different sectors which will create immense wealth for you. So wealth creation will happen, but will the same stock create wealth? Maybe 5%, yes, but the 95%, the players will change. And overall, there will be wealth creation, but the players will change. And we have to be extremely agile of understanding that we don't love our stocks, we love our profits. So of course we love our stocks when they are doing good, but when we are not doing good, we have to take a call. Like for example, Kapil Dev is the best player India ever had, but can I make Kapil Dev play today in my top 11? I can't, because he's not fit. The same way, tomorrow, for example, Rohit Sharma could be the best player today, but tomorrow he could not be. So that's a very simple way of understanding that you need to understand, review the portfolio, and the performers you need to make them stay, and the underperformers you have to take a call. And sometimes it's a harsh call, but you have to take a call, and that's how it works. So, how we find the next wealth creation opportunities? So, first of all, we see the next big macro trends. So, we feel that there are three macro trends which we find. One is IT. IT has three under macro trend. One is the services, the products, and the subscription model. Second, we love pharma. We like pharma very well. And the third is chemical, agrochemical, and chemical. So these are the three macro trends we see at Turtle that can be multi-baggers in next 10 years. The second which didn't grow in the last bull run is a very big factor. So if you see IT specifically, they didn't do great in the last bull run. There were few multi-baggers, but there were so many companies which were available at 7 8 years of the same market cap and the price. We see the sector, then we see the stock, and then we put it our at triple P theory, which we will talk in coming time. So we are why we say we are the most process oriented company. So when we this comes from a very beautiful book called Trend Following by Michael Cowell, and he says that if you're answering the question, 5 questions before you enter a investment, you make the most beautiful investment, because it's most logical and not very emotional. So we have a copyrighted formula of investing is called triple P. Now, triple P formula comes from a word from price, profits, and people. So, on price, we see companies which are technically on a great price model, which is above its 212 EMA. The price is very stable. It is not broken down, because we are a growth. We are a growth investor, not a value investor. And then only we will put the money into that company. We won't put money into the companies which are broken, thrashed, and there is an investing opportunity. So we always say that there is versus if investing process. Is that today this company is doing good, tomorrow there is a probability that it will do more good. Or versus an if investing. If investing is that today this company is not good, but this happens, then the company will do good. on our 15 years of research, we have found that is investing is so much ahead than if investing. If has a probability, but is has certainty into that companies. P is profits, then we see 8 peripherals into the company. First is horizontal growth, the company should be growing onto a horizontal sector. Its moat in the business, it should be extreme leader into the business. It should have high on corporate governance, lowest to zero debt to equity, least possibility disruption. Can we see? So I'll give you an example of zero debt to equity. So there was a huge debate about Reliance versus Bharti. The only reason Reliance eventually. So that is a very, very important factor. It comes again from my grandfather, who always told that, returns you can't make every day, but interest you have to pay every day. So if you evade the companies or the people who hide at companies, who is the smartest man in the room? So least this possibility of disruption. Can this possibility can be replicated with any model? High entry barriers in business, consistent track record, so the profit should be superior, the sales should be superior, the return on equity should makes a lot of sense, and there are growth potential. We don't have any hurdles that okay, fine, we will only buy companies with a 10 return on equity, or 20 return on equity, or 30 return on equity, because every business has different way of judging return on equity or return on capital employed or profits. But we generally see that it is very decent. I can give you one of a very good suggestion which I have seen in my 15 years. If the company is not making consistent profit, or the company's profit, I'm talking yearly profit, year on year profit. If the company year on year profit is not growing, or it's not at all time high, most of the company will not be able to create an extraordinary wealth creation for you. Yeah, there would be some examples which could have created good wealth, but if you see from 9 companies which has created wealth would be at all time high net profits. And that how it works, because net profit is like a result of your kid. Whatever he does at the end, how much money he makes, and whatever we say, net profits are like a heart of a human body and for the company. And of course, the sector in the company should have an exceptional growth potential. So this is one. The second P what we see, and the third P is the people. In this, what we do is that we do a lot of scuttlebutt, where we go to people, we talk with people, the clients, the employees, the dealers, for going to stores to store to understand what the product, the pricing, how people are buying it, how people are not buying it. I'll give you an example which was one of the best decision making for us when we were seeing paints. And we found that Exo Noble, that is Dulux, is available at a great valuation in comparison to Asians Paints or Berger. And when we went to doing the third theory, the profits, sorry, the people, and when we found that actually Exo Noble is not doing growth because the sales are not doing that great in comparison to Asian or Berger, and that's the reason we never bought. And if you see in last 2 years, where the Asian and Berger has been, and where Exo Noble has been. So sometimes going into the skin of the company, understanding, not getting insiders, but understanding the market breadth, how the products are being placed, how the management are taking decisions. Like I'll give you one example. I'll not name the company, but it is a lingerie company. So we went to our client who holds a lingerie, shop, and we asked that, what do you say about this product? And he said that the products are okay, but the management is worst. They don't have any process, they don't have any billing, and this company, we are not going to sell this company products. And that's why how we created. So most of the people see the fundamental side or maybe the technical side. We have added one more sector, and that is going to the skin of the company, understanding it, and that makes our process so robust. So what to buy comes from it. How much buy? We have very focused portfolio. Average our investment is 15 stocks only. We come somewhere around to 18 stocks, but average is 15. And allocation goes as per our total risk management system, which I will take in the later part of the presentation. And when to buy, we comes from again Charlie Munger, where I'm a big fan. Lollapalooza effect, when price, profit, and people all three mixed together. We have so many companies where the price, profit, and people doesn't match, and there we don't invest into. And the most important question here is when to exit. So can ask yourself, wherever you have invested money, maybe a fund manager, maybe an advisor, maybe yourself, do you know your exit right now of all the total investment without any bias, the precise exit level? So we at Turtle are so clear on exit that whenever we enter into the company, we decide the exit before we enter into the company. And that's how we have three exit strategy. One is the price, which gives you a clear exit if something wrong happens. Second is if there is a structural management problem into the company or something which is not right into the company, there is a second exit level. And third is we call it star strategy, three-star strategy, where if the we start the companies by their ranking. So three is a very good, two is okay, and one is bad. So one, if this company is not performing and we get the third star company, we may change to from a one star to three star to make the portfolio more stronger. And that's how we do. So first is we decide when to exit before we enter. So at Turtle, nobody has a bias that this company is good or bad. Maybe this company can be the best of the best, but if the exit comes, we have to get the exit right. And if the company is great, if the company is superior, people have a lot of great news, but if it does not set for our triple P process, it doesn't come into our process. And this process we tell openly to our investor advisors, everyone. So tomorrow, as a fund manager, if I am biased to buy something which is not in the process, everybody can tell, okay, fine, this stock you should not buy because it is not in the process. And we pyramid as per again the process of, if the company has done more better than before. Like we have a company who is 77% market share of pizza in India, and we had three rounds of pyramiding into the company because all three times it has done more better than the previous one. And it's the same thing, we have a company which holds the biggest recruitment, online recruitment in India, and we have now the five rounds of pyramiding into the company. Again, it works like the same module. If you have an employee, you got it at a specific salary. If he or she is doing more better, you will give more money to him or her. The same way it works at Turtle, with very focused approach, extremely process driven. So why I say 5% gyan and 95%, sorry, 5% vigyan and 95 sorry why I say 95% vigyan and 5% gyan, because all the processes are being made by the decision are made by process. But to buy an Asian or to buy a Berger or to buy a Exo is a 5% gyan where we take an allocation. और बाकी एशियन लेना है, बर्जर लेना है या एक्सो लेना है, वो तो प्रोसेस ही डिसाइड करती है. So that's how it is so process oriented, and the more it is process oriented, the less decisions you have to take, and the more you focus on to the right things about the company. So I'll speak more on investment rationale. We have a multi-cap investment strategy up to 18 stocks. Benchmarking is 500. Investing strategy is growth oriented. Stock selection approach is bottom up. Liquid money, we invest in liquid funds. No sector specific approach. You will be surprised today. We don't have a single banking and financial stock. Specifically, leaving the gold loan aside, we don't have any stock into our portfolio. There would be so many portfolios who would be holding certain companies, but because this all company doesn't come in our process, we have not bought it. And that's what we say is the process oriented fund. And no minimum investment approach, we can go 100% in, or we may go 100% out also from the market, depending on to the exit points. So we have one of the most beautiful algorithm risk management system. Now, when I tell, I'm sure you have played Jenga blocks, or you have played, this is the domino effect, that how I can, stop the risk for my client. So what we have done at Turtle is that there are two questions when you invest into a PMS or any fund. So one is, first is the biggest is that how can I tell my clients that, okay, fine, if you invest whatever the markets can be, your risk is only this much of the percentage in one month to month. So we created an algorithm system which is so specific that the investment money, you don't go below 18% on month to month basis, month to month MOM, in normal condition when the markets are open. The allocation is so beautifully done that there is no emotion into it. Secondly, the biggest problem in all the PMS, or whenever I seen, including ours before, was that when a client comes logins, he gets generally the model portfolio. Like for example, previously the fund would have a A stock which has an allocation of 15%. He would also get most of the time that 15% of the stocks. Now, if that stock goes north, goes south tomorrow, that will be a huge problem because generally it's a huge hit to the portfolio. But my previous client would not mind because they already have made money into that stock. So generally, we don't allocate according to the model portfolio theory. We allocate according to the risk management theory what we have created, and that's how we can tell to our client. And I'm not telling just to it; it is in our SEBI prospectus that our maximum drawdown to the portfolio is 18% month to month. So if you are investing, your invested money would not go below 18% in most of month to month on general scenario. So this is one of the most beautiful crafted thing in Indian PMS industry. So if you invest with Wealth Mantra Fund, what you get? So we love the market share business. So you get online catering business 100%, baby milk powder 96%, commodity future trading 94%, online job portal 90%, organized pizza 77%, adhesive 70%, paint 60%, B2B market 60%, and so many of the stuffs. So all the 15 companies what we have invested, you won't believe they are all leader into their perspective sector, into the business. We don't have a single company who is the second leader to it. We all have the leaders, and what we have seen in last 100 years is that leader are the companies who create exceptional wealth, and they are the least to fall and the first to grow. So it comes again from a Gujarati baniya thought process के ऐसा धंधा करना चाहिए या धंधे में निवेश करना चाहिए जो तेजी में पहले पार्टिसिपेट करे और मंदी में सबसे लास्ट आए. सो हमने ऐसी 15 कंपनी में निवेश किया है. So the growth comes first to it, and the downside or the fall comes the last to it, and that's how magnificently it is created. So we tell to our investors that all the total wealth investors would have a hashtag called is proud to your portfolio. That you would be proud holding something which is so amazing company. Forget about the returns. When you see your portfolio, are you proud? Oh my God, what a portfolio I have created! What a company I have! And that's how the returns are created. When you go to that bed, at 9, 10, 11, you feel, oh my God, I have certain best 15 companies business with me, and that's I think so. That's more. Eventually, I feel that's more powerful than creating a lot of returns. You should feel proud of what you have. So right now, I'll just give you a wealth allocator. So we invest 50% into most of the time, an average 50% into compounders and 50% into growth companies. So compounders are the companies who are structurally, vertically doing compounding great returns from a lot of period of time. Companies like Asian Paints, companies like Pidilite, companies like Nestle, and there are companies on growth side called Jubilant, Naukri, etc. So you have mix of both into the portfolio. It is not only the the compounders into the portfolio, only the growth companies into the portfolio, and that's what we have important. We have seen at the time of COVID, the maximum drawdown we had in our portfolio was 15% month to month, only 1.5% month to month, and that's the biggest strength we have seen. And that, I think so COVID was one of the worst thing which has happened overnight, where the whole economy stopped. And if at that time we are 15% down, I think so that says volumes for us. And in equity allocation, we have 58% large cap, 28% mid cap, and 14% small cap. On sector analysis, the same thing what I told. You have to be skin in the game. We are exceptionally bullish on IT services, so we are 24%. Food and beverage is 17%. Chemical is 11%. Financial services is 9%. Pharmaceutical is 6%. So we have as per the same. So of course our fund is an year old, but our strategy what we have done is from last 10 years, and this has been our strategy returns. Very very safe sound strategy, not very extremely volatility. Our beta is below zero point 0.5. If 1 crore would be invested, it would be 6.9 crores, and in Nifty 500 it would be 2.1 crores. The alpha is 4.8. Of course, this is a back test. This is a past performance, and this doesn't guarantee a future returns, but this has been. And if you see the volatility of the drawdowns, it has been very 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 less. And that's what we believe, that if you don't do bad in bad times, you would do much better in good times. And that's where we have a biggest, we don't understand, generally people don't understand that it is so important to do less bad in bad times. Because if you do less bad in bad times, you eventually do so good in good times, because you have a lot of money. Again, it comes from the negative compounding point, that if you lose 50%, you have to gain 100% to come to the break evens, and that's very painful, believe me. So I'll just taken the first client of ours, because we have got a different point. But our alpha has been the current, the PMS alpha has been more than 8%. We This is still 30th. This is still 1 year. This is still October. So of course the return would be have been more in last 10-15 days. So it has been 7% return versus Nifty 500 to be minus half percent. So this has just been, I'm just putting a statement to you to just show what has been the return. And sorry. So we are also going to come down with a fund which is a growth mantra fund, which focuses on investing into small to mid-sized companies, which has an average market cap of $1 billion, that is somewhere around 7,500 crores. So I've just give everything, stock picking and everything, the same procedure is, everything is same. 15 to 18 stocks, all thing is same, but here we pick up only the leaders and generally mature businesses. Here we will pick up the companies which is especially small but has a lot of growth potential. So we have now two funds specifically. So I'll just give you a difference. The risk is moderate in Wealth Mantra, the first PMS we have talked. Growth Mantra, the risk is with a bit of high volatility as per the SEBI regulations. Investment in leadership and mid-sized company. Here the investment horizon has to be long term. Here the investment horizon can be a medium term to long term also, because generally we invest here in compounders and here we invest in cyclical business. So there could be time that I'll give you a recent example, that there are certain companies which in last 1 year has done 3 to 4x in a year, whereas in this companies this has been consistent compounders. So here the only difference is Wealth Mantra is our signature product, which is only PMS. Growth Mantra is our PMS and advisory both product. So if you want to invest in your account with your discretion, then you can invest there also. We would be an advisory side and PMS side both. So for more details, you can always ask a question, but just to give you a brief. So why we? It is so important why we. So we at Turtle, when we were investing, when we were taking PMS license, we had seen overall that how we can make this PMS industry to grow so better, because we are just still a very small industry, and how we can do something which is exceptionally that in next 10 years we would be into the top 3 of the industry. So we have made our process so structured, and why we are, and to be different than all the PMS, most of the PMS rather in the industry. So we are having an exceptionally disciplined approach of 5 questions, which we tell to our clients also that why we do it and how we do it. So it is so transparent, because it's your money which has been invested, and this is how, where it's fund manager and investor process is like a husband and wife relationship. It has to be so strong, because if you don't understand, most of the time divorce happens. You have a great drawdown cover of your investment. You're investing into growth and compounder business. Both you're getting in one portfolio. We are extremely focused PMS driven company. We don't have any other products. We don't do any other broking business or any other insurance, any other financial products. And we are the owner of the company. So tomorrow a fund manager won't change with us. This has been a very big problem into our industry, but yeah, here the fund management doesn't change. And we do a structural quarterly review, which is like every quarter of first Saturday, the first month of first Saturday, at 4 to 6, we all of course now on Zoom, we meet a fund manager, the research analyst, the advisors and the client, and we talk about what we have done in last quarter, what are the learnings, what we are going to do, and this is a meet which is so transparent that most of the time when you invest the fund, this type of meet generally doesn't happen on the disciplined way, but we do onto the disciplined way. And the second meet happens is your one-to-one review on what has your performance been. It could be any part of the world, we can still do the meeting. We have a very important factor in our PMS is that we only invest in human friendly businesses. So we don't invest in companies which are directly into any killing, or maybe like anything which is like a leaker or a tobacco or a drug, or maybe high debt companies or management questionable companies. We only invest into human friendly businesses which are doing superior. So if this matters to you, it matters to us. So that's how it has been in our portfolio, that will not buy any companies which are not human friendly companies. And this is a very important factor. Maybe not in India, we don't talk much in India, but if you see abroad in the world, it is so important. Like for example, recently we are taking a decision of not investing in companies which have a lot of pollution and carbon issues. So we're not yet decided, but this is one of the approach what we are going to do into our business. So this is a very important ethical factor which we have taken into our PMS. We are in fee side, we have the least expense ratio. We would be the PMS side where, except our fund management fees, there are no other fees which we earn. Our brokerage, there are three costs: brokerage, custodian, and the auditing cost. All three are the least expense ratio in the industry, because we don't want to earn anything out of it. So your expenses would be so minimal that it won't even affect you. And we have a very transparent fee structure. And we have, again, as I told, we have no model. Portfolio approach is as per your risk management system. So we have two type of fees. One is 2% annual fee, no exit load. And second is performance fees, no annual fees, 18% profit on higher watermark. And of course, there is an exit load if exit prematurely. So the commitment what we give to our investment is, you should be proud. You will be proud of your portfolio. We are capital growers, not accumulators. As the AUM increases, your cost decreases. As we decreased onto the other cost, it is now the most minimum in the industry. Highest level of transparency and discipline of what we are doing, why we are buying, why we are selling, everything across. And whatever we earn, we are going to reinvest again in making the more options better and better for your experience as an investor and as a wealth creator. So I'll not put more time. I think so. There are four things which we see when we take investment. Minimum 5 years of investment approach. 18% downside is possible. No leverage funds. Leverage means if you have a CC or an OD, or if you're taking a loan and giving money, we won't accept. And you should be comfortable with our process of investing. Of we are going to buy growth oriented stocks. We are going to exit if the company doesn't do good. Though our churning ratio is very low over the period of time, but still, if it doesn't do good, we would be open to sell, and we would be open to replace it with another company. So this is what is our process. This is two things which we do: PMS, wealth advisory, and wealth management. So whole 360 degree. This is just a book picture. And there is also triple P approach we have at Learn app. If you want to learn the whole approach about how we select the funds and how we select the companies, that's a whole interview we have at a Learn app also, specific interview. So this is it from me, guys. I would be very happy to answer if you have any questions and make things more clear and more transparent.
Rohan, thanks for taking us through, and I appreciate your analogy during the presentation. As spoken in the beginning, we have collected few questions from PMS Bazaar investors. I'll just, I
Okay.
mean, let us take that questions first, and then we'll move on to the forum questions, and if time permits. So the first question is that, do you use technical analysis as a risk management tool? If yes, is it effective?
Yeah, I think so. Technical analysis, generally we have taken technical analysis as a very bad approach, like it's only for speculative traders. But I think so. Technical analysis is all about seeing prices. It has made a huge impact. I always tell to my investors that fundamental tells what to buy, technical tells when to buy and when to exit. And if we merge both together, all the positives of fundamentals and technicals together, you create a very big robust system.
Fine. So the next question, how do you do this active risk management system?
So I have to take you to my a simple software where I tell to our clients. So I'll take you to my Excel sheet to give you a fair understanding on how we do the risk management system. So can you see my
Yes,
Excel
yes.
sheet? Yeah,
Yeah.
so I'll give you an example. Please don't look forward for which are the stocks or something like that. But for example, if somebody is investing 1 crore with 18% risk, that is 18 lakh of the portfolio. So in one stock, we will take a risk of not more than 1.2% of the total portfolio. So for example, in 1 crore, we will take a risk of 1,20,000 only. So now, if the stock, for example, today this is an A stock, if the price is 16,200, my exit is 12,000. So now the most important thing is to know the exit before you enter. So when the 12,000 price comes, automatically my allocation is decided by the whole process, the quant, not by my emotional endeavor. So now what happens is that when a client comes, like for example, this 16,000 price stock, I eventually invested at 4,000. So now at my first client who is at 4,000 would not make any difference if 12,000 comes, but my first last client would make a difference for him. So for him, the allocation will come as per his risk management system, not as per my model portfolio system. So every stock has an exit and every stock has an eventual allocation. So for example, if you see here the risk stock, this is a specimen. This is not an exact thing. This I've just made a random pricing size. So please don't judge me from 30% or 20% or 14%. So for example, today, if somebody comes today, his risk, his invested value is 80 lakh, his 20 lakh would be cash and risk would be 18%. So this is so clear that before entering we share this screen to our clients, because clients also understands when to exit, and it is so transparent that we both are onto the same board, that why we are allocating 80%, why we are allocating 90%, or why we are allocating 50%. It is not what we are taking call on markets, it's all on risk versus reward approach. So that's how we calculate our risk management system for all our investors.
Interesting, Rohan. So I'll move on to next question. So can you tell me more about human-friendly portfolio and why it has taken?
Yeah, so see, we all where we started our company, we all are specifically, of course, Jain and Hindus. So we believe of not killing animals, and we are exceptionally onto that zone of, that we should not do anything which is problem to any humans. So we had decided initially, and of course, Nemish Shah, the pedigree of Inam, had taught us that why it is so important to invest in companies with human ethical businesses. And we took this very seriously, and we took the step of, I'll tell you a story which hit at us. So there is a company who makes this net of fishing, for fishing. And when we visited the company and when we saw that how much killing is there, and it is person to person, it is not like that what we are doing is the only right thing, but at our ethical level this makes a lot of lot of sense to us. Then we decided that why we should invest into companies which is doing that. There are 500 different companies which we can invest, and it is not that we will invest only in this type of company. So first we made our board decided that let us decide that what type of companies we would not invest in. So this is anything which is a direct killing business, where the 90% of the revenue comes from the business from direct killing. It could be anything, it could be bird, animal, or anything. We would not invest in direct liquor business or a tobacco business, drug business, high debt company business, management questionable company, and a company which we have an insider on. So these are the companies what we are not going to invest in, because we have a very clear point that we don't want to break our ethical values to make money from the market. So that's how it was the reason. So again, for the people, let me put it very clear again, for the people who favor eating a non-veg or liquor or having liquor, we don't have any problem. We are open to it, but we are not going to put our money or our client money into that businesses. That's the whole point. So we have no discretion for anyone.
That's great. So I'll move on to next question. What are the difference in holding structure for the growth mantra versus wealth mantra?
Yeah, so there is exactly no difference on holding sector for growth mantra and wealth mantra, honestly. But we believe that the because the nature of the company of wealth mantra is exceptional leaders, so it would be on a more larger scale. And investing into growth mantra would be investing into cyclical businesses. So maybe the tenure could be smaller. But the whole specter comes that till the longer trend doesn't end, we are not going to exit it. So it's how it works. So there is no definition of that here I will hold for 5 years or that I will hold for 1 or 2 years. It's nothing like that. In growth mantra, we have seen that companies we have hold for 6 to 7 years, or maybe for 3 to 4 months companies.
So the next question, with current uncertainty, what will be your cash holding? I think you have already shown the slide. If you can able to elaborate your current cash
Yeah, so
holding.
so it depends on client when it comes. Honestly, it is so currently I can tell in my fund the specific cash, the overall cash holding is 7%, 7 to 7.5%. But we can come specifically anytime on cash as per the market volatility. So we generally don't get it onto the market timing that okay fine, this is the market timing. So if market is going up, because honestly we believe that nobody knows what the markets are going to be over the period of time, so we just put it on, let's the market decide that how much allocation it has to be done, and let's my process decide that how much allocation it has to be done, rather than I decide or my team decide, because humans generally go wrong, data doesn't go wrong.
Okay. So there is the another question somebody is interested to know. Can you
Mhm.
talk more about your risk management system? How do you limit the drawdown to 18 percentage?
Yeah, so it's a very simple theory. Again, we work from a very simple thought process. If you divide 18% divided by 15, that comes 1.2%. That is this of the portfolio per stock. So if all the stop losses, all the exit points are hit, then only your 18% process comes, or then only your 18% trigger can be hit. Now, if this all companies gets an 18% of trigger hit, that means eventually the market is going to be so bad, then only is going to be there. In COVID times, we only got two exits at the COVID time from the 15 investments we had done. So in COVID times also, if we could do only two exits, so I don't think in last 15 years there has been so bad time in a shorter period of time than COVID. So eventually this is not going to be so prevalent that your journey is going to be up and down. And also the exit points revises every month. So this when we invested in a stock at this price, like for example this is 16,200 and 12,000 as an exit point, so it may revise to 14,000, 15,000 also very fast. So it's if right now the allocation has been done this, but eventually it can, your exit point can rise and your risk can come down. So that's how it has been done.
Great. So the next question, so let me address that question. Somebody is interested to know where Turtle stand when compared to its peers in the league table. So I would request the participant, the person who raised this question, to visit our website, where not just Turtle alone, we have more than 170 strategies which has been listed in PMS Bazaar website, and you can compare between these strategies. So I'll move on to next question, Mr. Rohan. We see you are overweight on IT, pharma, and agri-chemical, but these
Yeah.
sector have done extremely good in recent time. Your thoughts?
Yeah, so see, I, lot of people ask me that IT pharma has done very good in over the period of time, but I'll tell you, if you see certain stocks in IT specifically, still they have not done net great at all. Like if you see TCS, if you see HCL Tech, if you see Wipro, eventually I'll tell you, Wipro has not crossed its 200, 2,000 high also. HCL Tech was an 8 years of consolidation. TCS was five quarters of consolidation. Infi was a great consolidation which has been broken up. Now they are doing more better. The small IT companies. I'll tell you a company name, a small company name. Again, it's no company which I'm discussing is an investment advice. It's just an example what I'm sharing as per the disclaimer. Is persistent system. If you see persistent system, it is 7 years, 8 years of breakout. 8 years the price is at same level. The profit is expanded. So IT, I feel just it has grown. And I'll put a point. it would be very interesting after COVID. The only index which has done an all-time high pre-COVID price index specifically is IT. No other index has done an all-time high pre-COVID prices. So this is very interesting. Secondly, comes to pharma. If you see pharma on a larger scale, like Ciplas and Orbindos and Abbots and Sanofi, these are all larger pharma companies which has not done great. We can see small pharma companies, API companies which has done fairly well. Yeah, that is right. But still, the big pharma companies have not just started. So see, whatever you say, the big pharma companies holds a lot of importance. Like maybe if you see Aurobindo is maybe a 7 years of the same value, or Cipla maybe 10 or 12 years of the same value. So there are certain API companies which has done good, but there are a lot of opportunities in pharma on and grade. Of course, debt and USFD is a very important concern, but yeah, we still feel pharma is superior. And coming to, I think so, last was chemicals, if I'm not wrong.
Yeah, agrochemical.
Yeah, agrochemical, if you see, there are no companies which has done specifically very well in agrochemical. And we generally underplay the Indian markets, because Indian markets in specifically in agriculture has moved so well. Now the new generations are coming. Farmers want to spend more on good crop. People want to eat good. Today, organic food has a lot of business visibility. So the new tech pharma which is coming has, sorry, new tech farming which is coming, or agriculture which is coming, has huge scope in market today. Which generally this trend is not seen by a lot of people, but we feel it has an exceptional wealth creation in coming a decade or so.
Great. So I'll move on to next interesting question. In today's time of declining inflation, is it possible to achieve 20% CAGR return?
So we don't tell our client that how much returns. Generally, we have a simple math. So simple math is that if you want to create if you want to create 5 to 6%, it is the FDs. Into two is your mutual funds, and into three can be a PMS or a direct equity, PMS AI, whatever we can speak for, a direct equity focused. So at Turtle, our target is to achieve 20%. When we will see after 10 years and we will ask ourselves that have we created a 20% CAGR, then only about 20%. So 20 is not a hurdle, but about 20%. Then only we will feel that it is possible. And I feel in next 15, 20 years, there will be companies who will be creating exceptional value, more than 20% CAGR in coming 10 years in a row. So we just have to find that opportunities. There are opportunities, and we have to find it. That's what I think. So that gives us most boost of finding great companies. And this is also very important for the one who has asked that doing 20% CAGR it is important, right? But not losing a big value is more important than doing 20% CAGR, because in 10 years, generally 2 or 3 years will be there that you will achieve an exceptional exponential return in portfolio. It could be 17, 16, 17, 18, or if you see, it could be 6, 7, 8, 2005, 6, 7. At that time you have to be ready with all the things in your portfolio. So once the market starts giving you a fair value to whatever you have invested, eventually you will start to get a lot of return. So it's not a guarantee, but that's our target at Turtle Wealth.
Fine, Rohan will take the last two questions, and
Okay.
if the questions is not been addressed, I would request you to address the question via email. That is a practice. So I'll send across the question. So the last two question, I'll move on to one question. What is a 212 degree in the name?
Yeah. So I was very much inspired by this 212 degree. So when I understood it, so 211 degree Fahrenheit, the water gets hot. So water get hot, and in 212 degree water gets boiled. So 1 degree makes a lot of difference from a hot water to a boiled water. So hot water cannot do a lot of stuff, but boiled water can cool a train also. That's the power of it. And if you see from sports to investing to business to individual life, that 1 degree changes to you to be successful, extremely successful, or not to be successful. So for us at Turtle, 1%, 1 degree is our process, and that's what is 220 degree.
Interesting. So I'll move on to the last question. What's your vision for total wealth?
So our vision specifically for Turtle Wealth is when we started, honestly, we never thought that we would manage people's fund. But eventually, when generally I'm more an extrovert person. I'll speak a lot of markets, like 24 hours. I can speak on markets, on the great companies, how the wealth has been created, and people started approaching to us. And eventually, after 6 7 years, we got a PMS license into our company. So our vision, honestly, in the next 10 years is to be we will be the top three into the industry. Rather not by the AUM, but the AUM, what the wealth we have generated to people. So AUM is just a number which I believe that is not a game, but how much wealth you have generated to people is more accountable than how much AUM you have gathered. And in next 20 years, we would be the leader in the industry.
Great, Rohan. I appreciate your time, and I also appreciate your colleague Hardik was addressing many questions in sideline in the chat. But still, if any question has been missed out, we ensure that you will receive the answer in the next couple of days as a practice. Thank you, Rohan.
You're going to
Any
put my,
closing note you would like to give?
sorry.
Any closing note you would like to give?
I don't have any closing, no, but just I think so. I told most of the things. If you have any questions, you can put my email address. That would be great.
See,
If
what I would request participant is that if you have any questions, you can send us to
yeah,
info@the rate of pmsbazaar.com, info@the rate of pmsbazaar.com. In a week's time, you will receive an answer to that
okay,
respective question. Rohan,
okay.
thanks for your time. I appreciate your time. And participant, thanks for your time. Have a great weekend. Thank you very much.
Thank you, PMS Bazaar, for giving us opportunity and looking forward for that in next 10 years we both are leaders into what we are doing.
Great. Thank you.
Good day.